Many people new to options are drawn to high volume, like a moth to a candle flame. It's important to understand where that volume is in relation to the price of the stock. Very often options are sold as a defensive move to protect a position in a stock that might be getting ready to go down. The additional premium brought in helps offset the price movement of the stock and offers a hedge. What I'm talking about is the covered call. Someone who owns stock will sell call options that are above the price of the stock. These calls are out of the money. To some, this significant increase in volume of the just out of the money calls appears to be a bullish signal, when in fact it may be quite the opposite. Keep a close eye on what I call the covered call zone. Covered call sellers like to sell calls that can bring in somewhere between 1 and 1.5% of the purchase price. These are often the first 2 or 3 strikes above the current price. Let's take a look at an example. Today there was a nice spike in the call activity of AVGO, Broadcom Limited. You can see from the screen that the call volume was more than double the put volume. You can also see the call volume was about 1.5 times the average call volume of the past 10 sessions. On the surface this may look bullish, but let's look at the chart and see where Broadcom is in relation to its recent trading range. In the past few months, the stock has traded as low as $115 and as high as $159.65. With the current price at $154.36, it's near its high. This suggests there will be some significant resistance at the $160 level, and there needs to be a push to break out to new highs. Now, let's take a look at where this call volume is located. Looking at the July series, you can see that much of today's volume was just out of the money from $155 to the $170 level. The stock closed today at $154.36. So looking at the math, the $155 call was priced about $7.45. This is nearly 5% of the current price. The $170 call was priced at about $2.45. This is about 1.5% of the current price. The $155 call premium all the way up to the $170 call make attractive returns for the next 45 days. They also add some downside protection if you own the stock. The $155 call will bring in $7.45, thus lowering your cost in the stock by this amount, should the stock go down from this point. What often happens is somebody gets excited at the possibility this signals a bullish move for Broadcom. They buy some $160 calls at $5.10 thinking the stock is going up. Then the stock runs into resistance at $160 and levels off or even goes back down. Then your $5.10 call goes to zero and you say to yourself, these options are risky. So be careful and don't mistake downside hedging for upside potential. Watch AVGO for the next few weeks and see how this plays out. Otherwise, you may find yourself in the covered call zone.